Welcome back to another petty cash lecture. Today we're going to be dealing with lions and tigers and petty cash. So the first thing that you were told is that Jason doesn't understand petty cash. He mixed it up and he really needs some help. So first let's go through the entries Jason should have made. So on February 1st he wrote himself a check. So whenever you write yourself a petty cash check, or when a petty cash check is written, you debit the petty cash account. Now petty cash is an asset just like cash, but it just stays in your house. So it's like in your company. It's like a bank account. It just doesn't go anywhere. So remember what petty cash is used for. It's small incidental expenses that it's just too cumbersome or impossible to write a check for. So then we credit cash because the money came out of the cash account. Now from an internal control standpoint, Jason shouldn't have wrote himself this check. Someone else should have, so that there was a very clear distinction between what's going on here. So then the smart thing he does is he does go out and he does buy a lockbox and petty cash receipts. So 7 days later he's completely out of money and he doesn't know why. And he doesn't know what to do about it. So the first thing, so we need to record what receipts he has. Now he has office supplies. You could also put supplies expense if you're going to use them, right away. You don't need to adjust. Then there's going to be meals and entertainment expense or something. I've also seen donuts put to office expense because it's a de minimis fringe benefit to employees, and that's fine. And then you bought postage. You could put these to office supplies. You could put these to postage expense. You could do a lot of things with these, and that's 44. Okay, so I record all of the expenses. Now I have to figure out how much I need to put back in the cash account. So notice, I am going to figure out how much cash needs to go in by taking how much cash I started with minus how much cash is left. That is the amount that I have to put back in the petty cash fund. So this is beginning cash minus remaining cash. It's really important that I look at it that way because that's how much money needs to go back in the petty cash fund for it to go back up to that $100. Then to get cash over and short, I'm going to take and I'm going to total all of my expenses or my cash outflow, and that's $32.51 plus $21.74 plus 44 gives me $98.25. Then I'm going to calculate my cash over and short. And the easiest way to do this is to take your amount that you wrote the check for, so $98.95, minus my total expenses of $98.25, and I get 70 cents. So I have receipts of $98.25, but I spent $98.95. That must mean that I have cash over and short of 70 cents. You guys know debits and credits are supposed to balance, so I would double check your entry by adding both sides up. Now remember, I got this number by how much I wrote the check for, and this is from total expenses in petty cash. Now one of the other things that was asked is Jason doesn't understand what items should be paid out of petty cash. So one of the things that I want to point out to you is really when he bought the office supplies, he could have done that on a credit card. He could have done that. He didn't need cash. He could have wrote a check for that. That was a pretty big amount. I would also kind of argue the same thing with the stamps. Maybe not the donuts. Really what petty cash is used for is when it's not appropriate to either use a company credit card or a check. Now, not all employees have a company credit card. So if employees stop and get a cake for their fellow employees and a card, you're going to reimburse them out of petty cash. So just kind of keep those things in mind, and thank you for tuning in.